Hello and welcome back to this month's Insight series. There's a lot going on in the world right now, and for today I brought our energy and oil expert with me, Tyler Ellegard. Tyler, thanks for joining me today.
Well, thanks for having me again.
As I said, there's a lot going on, especially with conflicts and in the Middle East, and we will talk a lot about what that means for oil prices, what that means for our economy today.
Perfect.
Yeah, perfect. Before we start really digging deep into the topic, I'll start us off as traditional with the year-to-date asset class return, just so we get an overview of what markets are overall doing year-to-date in 2026. And when we look at the last column here, U.S. large cap stocks are slightly down and slightly in the red, but U.S. small cap stocks are still up. International and emerging markets, as well as gold, is doing fantastic so far in the year. And this is what we're still seeing as we are coming into the year, a broadening out and a market rotation, so more areas of the market are participating, which is helpful for a diversified investor. So Tyler, when we talk about today's topic and what's going on in the Middle East and the conflict, especially in Iran, then when we set the stage on February 28, Israel and the U.S. attacked Iran. And since then, there's a lot of talks about oil and energy markets to begin with. Why are we talking so much about oil when there's a conflict in this region, and overall we are seeing a little bit more politically unstable, especially in the Middle East to begin with?
Well, so a significant part of oil exports and transportation is through what's called the Strait of Hormuz, which is within the Middle East, and Iran has a significant border along it. And so when you start to have these types of global conflicts, what tends to happen is these oil shipping companies decide they don't want to be involved in the conflict with fear of being attacked. We've seen that in the news recently. There's 3 ships that have been attacked through the Strait of Hormuz. So what happens is a lot of the ships will anchor. They don't want to go around the Horn of Africa because it takes additional days, which, as you know, increases the cost of oil, because not only is it more fuel to get the ship around because it's an extra 10 to 14 days, but also insurance. And then there's also risk of bad water. Like, there's a whole host of reasons why shipping companies don't want to just go around, and they'd rather anchor in just before the Strait of Hormuz. But the Strait of Hormuz is a significant pass-through for shipping companies to get oil through from the Middle East. And obviously, as we know, the Middle East is a significant producer of oil and significant exporter of oil. And so when there are these conflicts, it tends to cut that off. And so that's why a lot of this has been not publicized, but in the news and discussed so heavily, is because of how significant that oil supply is for the Strait of Hormuz and therefore Iran and Middle East.
And especially 1/5 of the daily global oil consumption passes through this narrow choke point, which is significant. And like you said, it's first of all not easy to get around it. It's even more expensive, and we probably cannot just divert that 1/5 that we are missing now just easily around it. And as we are talking about the importance of Middle East as an overall global oil producer, and especially the significance of the Strait of Hormuz as a transport of this oil to the rest of the world, we saw some wild rides in oil prices this week and since the beginning of the conflict, with some record weekly changes in oil, and also some very dramatic daily swings. Why is that?
Again, because of how significant that supply is over there, but also just overall global conflict, right? You still have Russia-Ukraine happening. You have Israel and Hamas, which is for the most part done, but there's still some residual effects there. And then now you have Iran and U.S. So a lot of, and not to mention Venezuela a couple weeks ago. So you have all of these different conflicts. It just creates I don't want to say ticking time bomb, but it creates an environment for volatility in oil prices. And so what we saw was, and it reminded me a lot of what happened back in 2020, obviously a different direction. Obviously 2020 oil prices fell very dramatically and actually fell below $0.
For the first time back
then. For the first time, right? Thinking about for an oil producer to pay you to take a barrel of oil was pretty significant. But then, we saw oil go from, what was it, around $60, $70 a barrel, and it jumped up to about $120 a barrel, and then in that same day fell back down to about $85 a barrel, somewhere in there. So you saw some, and that was all in one specific day, right? So you saw some pretty significant price swings because of the conflict that's happening.
Absolutely. And when we talk about all of these dramatic price swings, and I think every American by now saw some of these swings at the gas pump. That's usually the first situation where you realize that when oil spikes. But that's not all, right? I mean, there's a very broad products, downstream goods and products where oil flows in, and that's actually much more than what you would see in the first place. So tell us a little bit about the importance of oil for our economy, for our daily lives.
Absolutely. So, I mean, on the screen here, I mean, you see all, and this is just not even every product that you can imagine that oil goes into, but we are an oil-based economy. It is what it is. And so, like you said, the first time you start experiencing these oil price spikes is at the pump. But then the after effects of it is lipstick, right? I'm sure you wear lipstick from time to time. I don't. But oil is the base of lipstick. Petroleum oil, right? Or petroleum jelly, right? So a lot of people use Vaseline. That is literally petroleum jelly. You start talking about all the plastics that we use. Oil is a component of plastic, and so anything that is made up of plastic has oil. So the ongoing effects of oil price spikes like this can cause a lot of different issues within the economy because you start to see price increases and things like that. So it truly is in every product that we touch on a daily basis, and so there is a lot of long-term effects that a spike or a rise in oil prices can have to our overall economy.
And when we think also about not only the products where oil is a component of, but also how it gets to the consumer, right? So we have increasing gasoline and diesel prices, increasing shipping costs, transportation. So not only is the product getting more expensive because of the higher input cost of oil, but also the transportation is very oil-based. So we have like two sides of the coin here.
One that you and I were talking about beforehand was fertilizer. So oil or petroleum is a base of fertilizer, and so not only is there a cost increasing to farmers who utilize fertilizer with their crops, but then you start to talk about the tractor costs. They need to use diesel in their tractors, right? So there's two areas where it's increasing. Now when they go to harvest, they need to transport the grains or whatever they're harvesting to wherever it needs to go. So there's another component where it increases. And now, depending on where that product is being shipped, whether it's overseas or from Minnesota, which is heavy soybean and corn, or Iowa, which is corn, to Florida, right? Like there's another component cost. Like just every step of the process
involves oil.
And so you will start to see that play into the prices of anything that you're going to be buying over the next 6 to 9 months.
And when you talk about these increases that we will be seeing over the next month, and sometimes it takes a little bit longer until it all flows through and it's received by the consumer, not with gasoline prices where we see it, like said before, very, very immediate. And when we talk about these products are getting more expensive for the end consumer, then we also have to talk about the economic impacts overall, the impacts on inflation, where oil, energy itself is a huge part, but also other products. So we have some double whammies in here as well, and also GDP growth, so the growth of the overall economy, U.S. economy. So can you touch a little bit on how it flows into inflation and how it can pressure the overall economic growth?
Well, so there's headline inflation, which is CPI or Consumer Price Index. And there's specific line items for oil and natural gas, and the true core product that you see on the screens of price movements. But then what we were talking about earlier is oil goes into a lot of different products. And so what companies will tend to do is push those prices through. We saw that post-COVID where we saw rampant inflation, 9.1% being the highs. that's what they're going to do. They're going to push these additional. Now, it depends on how long oil stays, right? If you get a spike to 102 for a day and it comes back down to 60, they're probably not going to pass through much for price increases. It's too much work on their part. But if you start to see this elevated oil price where maybe we, instead of being at $60 to $70 a barrel that we've been experiencing for the last year, and it stays around that $80 to $90 for an extended period, that's where you're going to start to see prices, because companies are going to push that cost through, and so you're going to start to see prices again affecting inflation in not only the core component of oil, but also a lot of the other consumer products that we're buying. And so from a GDP perspective, not only do you have to pay more for the tax on you going from point A to point B, but now more of your wallet share is going towards those traditional goods that you've been buying that were maybe priced at $1 and now they're $2.50, right? So now you just have less to spend, and so you start to see impact on actual GDP growth.
And when we think about the GDP growth, is basically 70% of it, the most majority, is consumer spending, so the buying decisions that you and I make every day. And if we have less discretionary spending because we have to more keeps on the road basically, and for other products, then we always have less to spend on the things we like, and obviously that damages the economy or economic growth, or can damage. And we also, when we talk about oil price spikes and what it means for the U.S. economy, U.S. inflation, and overall, then we also have to talk a little bit about the shifts that were happening in energy markets over the last decades, because I think people who are around long enough can remember the oil price spikes in the 70s, in the 90s as well. They looked very much different than today, because the US is overall less dependent, not immune, we see that, but less dependent on oil than it was in the past. So can you talk a little bit about how the import-export changes are influencing that? And oil, the US is now the largest oil producer in the world, how that is influencing overall the less vulnerability to such spikes compared to the past.
I think you hit it right. Even though we could be less dependent, we're not immune. And the reason we're not immune is we produce about 13 to 14 million barrels a day here in the US, but we also export about 10 to 14 of it. 10 to 11 million barrels per day. So we're not, and we consume a lot more than just 3 million barrels a day of oil here in the US. So a lot of our refining capacity here in the US is based on, there's different types of crude oil. I know that sounds weird, but there's different types. So the main ones are sweet light crude oil, which is what the US produces. But then what a lot of other countries produce is what's called heavy sour. And so a lot of our refining capacity, because we were so dependent in the past, a lot of our refining capabilities to refine these into diesel, into jet fuel, into products, like, it's based on heavy sour. The refining companies that transform crude oil into the products is based on heavy sour crude oil. So that means that we have to continue to import. So we are not immune, because we are still getting about 70% of our oil from outside of the US, just because that's how the refining capacity is.
And it's also not easy for these refineries to just switch to the sweet crude that the U.S. produces, because that comes with a very very capital intensive to just switch from one day to another. That's not possible. So Tyler, when we talk about all of these, the situation, what happens with the Strait of Hormuz, that we basically are missing a fifth of the global daily oil supply. And when we think of what product it flows in, what can it mean, a prolonged higher oil price for inflation, for the economy overall? Is there something that can be done right now? I mean, outside of resolving the conflict and that backup gets resolved again. But is there something that we can do now to ease the pain a little bit?
Yeah, well, a lot of countries have what's called oil reserves. And so the US has oil reserves, the EU has oil reserves that they can then release to try and help combat the price of oil, to try and keep it, because price of oil truly is your economics 101 of supply and demand, right? The less supply, the higher the price. The more supply, the lower the price, right? So if you can flood the market with more oil, in theory, in economic theory, it should lower the price of oil for you. And so they use that as a lever to try and keep the price of oil from hitting consumers too significantly. And so we saw that in the news recently, the most oil reserve release in history. The U.S., I think, alone did 100 million barrels. But again, with how much we consume on a daily basis, on a weekly basis, on a monthly basis, we would need the conflict to be resolved rather quickly.
So Tyler, when we do the math overall here, and we heard about the International Energy Agency releases 400 million, and you said it correctly, that's the largest in history. And when we do the math, 400 million barrels of oil, but we are missing 20 million barrels a day from the Middle East.
Doesn't get you too far.
Then it does not get us too far before we need a resolvement of the situation in order to get the supply back on track. But it helps ease the pain maybe a little bit in a short term.
Yeah.
Perfect. And when we zoom out a little bit again, because we always say, hey, at the end of the day, there's a lot of volatility at the moment, especially in energy market, that flows into the overall stock market overall. But we always say, hey, at the end of the day, in the long term, the economy and earnings growth is what's driving the stock market. Mm-hmm. And we zoom out a little bit. And you brought an interesting chart here. And it says if we would have invested $1 in the 1940s, that would have grown to a lot today. And when I see the chart goes up until the right, that's good.
That's what you want.
And we also see all of the wars that we would have faced along the way. So that is something that we should remember back to, no matter what short-term volatility is in the long term. That is
I mean, when we talk about earnings growth, we think about it more on a long-term impact, right? So yes, the market could be expecting 12, 13% this year for earnings growth. This could be a setback, right? Because we've been talking about the headwinds it could face to companies if companies don't fully realize or push through the price increases. Right, they get margin compression, which leads to lower earnings, which leads to lower earnings growth. So in the short term, it could have some impact. But from a long-term perspective, if companies can continue to grow at that 9 to 12%, which is what we've historically seen, that tends to be a good backdrop for the market. So despite the short term, yes, nobody likes to see war regardless, right? All of the points on the chart, you would say, I would rather have that not happened, despite the market going up. But at the end of the day, the market focuses on the long-term earnings growth versus the short-term potential headwinds and concerns and conflicts. And every year you're going to find something that's going to be a concern to the market, whether it's Iran-U.S., whether it's Israel and Hamas, whether it's inflation or government debt or whatever the case may be. There's always going to be concerns, but yet over the course of time, earnings growth of the S&P 500 companies is really what matters for the market.
Very well said. Tyler, thank you so much for joining me today, our resident energy oil expert. It was good to talk about this, especially what oil does in times of conflict, as we're hearing a lot of that lately. Yeah. Thank you so much.
Thanks for having me.
I will summarize what we just heard. Uncertainty remains around the length of conflict and the disruption of oil supply and where it may go. The severity of economic impacts at this moment is uncertain. But the economy and earnings growth drive stock markets in the long term. Yet high oil prices, especially prolonged high oil prices, can have short-term impact on companies' earnings. But it also reinforces the value of diversification and rebalancing back to your risk tolerance. And as always, have a long-term plan, stay diversified, but most importantly, stay invested. And with that, thank you so much for joining us today, and thank you for your precious time. We will be back next month with another exciting topic of what drives the markets.